Palo Alto Networks, one of Nancy Pelosi's newest stock picks. Today we're going to see where it could be headed, what it's worth, and why she may have bought. So jumping right into it, we have price per share of $293.84, a price to earnings ratio of 45.91, a market cap of $94 billion, and an enterprise value of about $90 billion. So Palo Alto is a cybersecurity vendor focusing on cloud security and other security operations. Looking at the financial strength, there's a 1.54, which means that for every dollar of debt, they have $1.54 to pay down those debts or expand the business. Looking at profitability, we can see a lot of green both versus the industry as well as versus history. So pretty good sign there. Looking at history, they have currently the highest gross margins in the last 10 years, the highest operating in the last 10 years, the highest net in the last 10 years, and for free cash flow, they're sitting just below that maximum. So the business is performing very well based on their profitability and their margins. But looking at management, I use ROE, ROA, ROIC, and ROC. And for these, we can see that in the last 10 years, these are the highest they've achieved for each one. So great sign there. Management's doing well. Looking at the price to earnings ratio, there's a current of 45.91 and a minimum of 42. So just about the minimum price to earnings that they've had in the last 10 years. Great sign, low price to earnings, good margins, good management, debt not in a bad position. Looking at their financials on a trailing 12-month, we can see that they were negative up until first quarter of 2023, and since then they've just increased that net income. So kind of questionable why they would be negative, but zooming out to the annual, the last time they were profitable was in 2012, and since then it was all negatives, even though their revenues were significantly increasing until now where they become profitable. So pretty good sign actually. Fairly small revenues, just about 7 billion here, but in the last 10 years they've gone from $500 million roughly, so from $500 million to 7 billion, 14 times their revenue roughly in 10 years. So that's a good sign, something I'd like to see even though there's not a lot of profitability here. So it all depends on their future earnings, but it looks like revenue should be up and to the right. And with that cash to debt, they had cash pretty much in line with their debts all throughout. And it looks like paying off those debts here and increasing the cash pile. Lots of share sales, so generally not a good sign, but could be just raising that cash pile, and maybe this is why they have a higher cash debt ratio right now. Looking at their operating revenue by business segment, we can see 48.4 in subscription, 28.7 support, and 22.9 in product. By geographic region, they have 64.2 in the United States, 19.7 in Europe, Middle East, and Africa, 11.8 in Asia Pacific and Japan, and 4.3 in other Americas. But to see what it's worth, let's run a DCF. Before we do that, if you do like these type of videos, make sure to subscribe to the channel and hit the like button. But in the DCF, we see low predictability and no data for the earnings per share averages because it's fairly new to being profitable. Based on free cash flow, we have some good data here, so we can look at that. But still, for earnings per share, there's 31% priced in for the next 10 years, so growing at 31 for 10 years. So that's what's priced in for earnings per share. If you think it's going to grow faster, then there's higher upside for fair value and lower. But looking at free cash flow, with 22% priced in for the next 10 years, there's roughly a fair value of what it is today. And in the last 10 years, they've achieved 33.6 annually, 20.5 over 5, and about 40 over the last 3. So it looks like this is fairly priced based on free cash flow. Earnings per share is a little iffy, but if you think they're going to grow at maybe 25 for the next 10, then we could see a margin of safety of 19.05 or a fair value of 363, whereas we're at 293. If you think they'll grow at 30 and roughly match what they have over the last 10, then there could be a fair value of 506 or about 60% higher than where we are today. And on a bearish estimate, if you think they're not going to achieve that 22% and you think they'll slow down to 17 over the next 10 years, then a fair value would be closer to 212. And if you think they really slow down to 15, or almost half of what they have achieved over the last 10 for free cash flow, then there's a fair value of 185, whereas we're at 293. So these are just fair values and estimates to try and get you guys to what a fair value could look like and what a hypothetical realistic could look like, depending on how fast you think the company will grow or if you think it will decelerate. So I'm just trying to give you guys ranges where you can see numbers and what fair values could be based on the annual rates per share and how it's growing so that you can value the business. So why is Nancy buying? Well, probably information that you or I don't have access to, but the business does look pretty solid all around. Am I buying at these levels? We'll have to find out. And I'm in the process of building a community to share those trades and insights and give you guys personal access, make some better trades together, beat the S&P. Again, that's our goal for the channel, is to beat the S&P 500. If you're not already, make sure to subscribe to the channel and leave a like. If you have any comments, leave them down below, and I'll see you next time.